Right now, there are two Googles trading. One ticker, GOOG, the other, GOOGL. Same company, same earnings, different price. There's a gap between them. That gap is a trade, and it's the tightest kind of pair there is, just one rung on a ladder. Over the last 5 parts, we built the machine that trades a pair, one piece at a time. Normalization, to put two different prices on the same ruler. The spread, to turn two stocks into a single line. The Cointegration coefficient, to tell us how many shares to buy and sell. The log spread, whose value is your return. And last time, the risks in the process a professional runs before every trade. The machine is finished. But here's the thing. Everything we've built answers one question: how you trade. Today's question is different. What do you pair? Out of the thousands of tickers on your screen, which two do you actually put together? And up front, the answer is not any two stocks that look alike. So let's talk about the types of pairs trading, what you actually pair. Here's the key idea. When a spread pulls back to its average, that's not luck. It happens because something binds the two stocks together, a bond, a kind of chain, and that chain comes in different strengths. If you line pairs up by how strong that chain is, you get a ladder with 4 rungs. The top rung is the tightest bond, the bottom rung is the loosest. The higher you go, the more surely the spread reverts. The lower you go, the bigger the opportunity, but also the bigger the risk that it breaks. Today we're going to climb down that ladder, one rung at a time. And at the end, I'll tell you what should decide which rung you stand on. Top rung, the tightest bond there is. 2 securities issued by the same company. Those 2 Googles from the cold open live here. Alphabet listed 2 share classes, one with voting rights, one without. Berkshire Hathaway's Class A and Class B shares are the same story. Same company, same earnings, essentially the same claim. Why is this the tightest? The law of one price. The same thing should cost the same. So these 2 securities move almost perfectly together. Their Cointegration coefficient is basically 1, and more importantly, this pair almost never breaks. It's the same company. One side can't go bankrupt without the other. Here, the ratio between the 2 prices, how cheap one is versus the other, sometimes called the discount, becomes your spread. In fact, if you take the log of that ratio, it's exactly the log spread from part 4 with the Cointegration coefficient forced to 1. Since the 2 securities are nearly identical, that's a fair thing to do. Of course, there's no free lunch. Because it's the same company and so safe, there's very little room for the 2 prices to separate. The spread is thin. Small profit per trade. On top of that, this discount can slowly drift in one direction for structural reasons like a voting premium. And with traditional preferred shares, even in the US, volume is thin, so it's hard to move real size in and out. Safe, but a modest rung. One more thing, the stronger the pair, the more your ratio matters. How many of each you hold. If you just go 1-to-1, you're ignoring the Cointegration coefficient, and that's the same as betting entirely on the discount. We'll sharpen that hedge ratio idea in the advanced parts. Step down 1 rung. The second rung, a holding company and the companies it owns. And here, what you learned last time walks straight onto the field. Think about it. A holding company's value is really just the sum of the stakes it holds in its listed subsidiaries. When a subsidiary's stock rises, the parent tends to rise with it. So these two are chained together by ownership. The catch is that pairing the parent with just one subsidiary is a weak link. So, instead, you take several subsidiaries, combine them by ownership weight into one basket, and pair that basket against the parent. That is the synthetic pair from Part 5, the technique of blending several stocks into a single portfolio stock. The holding company trade is where that technique shows up most naturally. You already learned how to build it, so you're ready to stand on this rung. You size it again with the Cointegration coefficient. Buy 100 of the parent and sell the synthetic basket scaled by the coefficient. To be honest about it, this structure, a listed parent standing next to its listed subsidiaries, is common in Korea, across Asia and in Europe, and there are fewer clean examples in the US. In the US, tracking stocks and a handful of holding companies sit in roughly the same spot, and while the bond is structural because its ownership, the holding company discount, how much cheaper the parent trades than the sum of its parts, keeps wandering, driven by governance and sentiment. so this spread carries some noise. Third rung. This time we pair a single stock with the index it belongs to. You put Apple together with an S&P 500 ETF. Why do they move together? Because Apple is a member of that index. And this is where a concept from your finance class walks in: CAPM and beta. Beta measures how sensitively a single stock moves relative to the market. And here's the quiet punchline. Beta and the Cointegration coefficient we've been using are the same idea. Beta works in returns, Cointegration works in prices, but both answer the same question. What ratio do I hedge at? A stock versus index pair is really CAPM turned into a trade. This rung has one very practical advantage. To short an index, you'd normally borrow it and sell it, and that brings the borrow cost and the maturity we saw in part 5. But instead of selling the index, you can buy an inverse ETF, a fund that goes up when the index goes down. That means no borrowing, so no borrow cost and no maturity. Buy Apple, buy the inverse ETF, and you have a pair you can hold for a long time. But honestly, this is the loosest bond of them all, so the spread takes the longest to return to balance, and most inverse ETFs reset daily, so if you hold one for a very long stretch, it can drift away from simply being the mirror of the index. That's the trade-off on this rung. The upside, an index doesn't go bankrupt. So the individual risk here is the smallest, and this pair almost never breaks. Go one step further, and you can combine several large caps into a basket and pair that against the index. Blend about 15 names, use futures instead of an ETF, and you've built the classic cash and carry arbitrage from the textbook. A basket versus index spread like that is very narrow and stable. You won't make much per trade, but the chances come often. Bottom rung. The most common and the loosest bond. Two rival companies in the same industry. Coca-Cola and Pepsi. Exxon and Chevron. Visa and MasterCard. Home Depot and Lowe's. This is the picture most people imagine when they hear pairs trading. But here's the crucial difference. Every rung so far had a mechanical chain. The companies were the same or tied by ownership, or one sat inside the other's index. Two rivals have no such chain. They only share an economic reason to move together. The same industry, the same demand. That's why in the picture, it isn't a chain, it's a thin dotted line. And this is exactly where last time's warning comes back. These two stocks can be very highly correlated, 90-something%. But high correlation does not mean a strong chain. If just one of the two companies gets hit with something specific to it, an accounting problem, a collapse in its core business, the thin line that tied them snaps. The spread doesn't revert, it separates for good. The fundamental risk we called the scariest one in part 5 lives right here, on this rung. So this rung is the biggest opportunity and the biggest risk at once. The spread is wide so the profit can be large, but it can genuinely break. When you stand here, run the fundamentals alongside it. That was the lesson of part 5. Now, rival pairs come with a practical headache. The upper rungs had their partner decided for them. A Google goes with its other Google, a parent with its own subsidiaries, Apple with its own index. But a rival pair, the partner isn't obvious. Out of thousands of stocks, you have to find which two fit, and that's a big job. With only about 1,000 listed stocks, the number of ways to pair them two at a time approaches 500,000. In the original author's experience, just scanning 500 stocks by computer took about 21 hours. No individual investor is going to run that every time, so professionals don't brute force it. They narrow the universe first, using structure. Group by industry, start from relationships you already understand, and shortlist from there. Then filter that shortlist on two things: the correlation and how stable the spread is. Higher correlation is better. A calmer, less jumpy spread is better. Thousands of possibilities collapse into a handful you can actually handle. Now put the whole ladder in front of you, top to bottom. One company's two shares, a holding company and its subsidiaries, a stock and its index, and same sector rivals. One single axis runs through all four. The higher you go, the more mechanical the chain, and the more surely the spread reverts. But the thinner the profit and the lower the liquidity. The lower you go, the looser the chain, and the bigger the opportunity, but the more it can genuinely snap. Reliability and opportunity move in opposite directions, so there's no such thing as the best rung. Want steady returns? Stand higher. Want a bigger opportunity? Stand lower. You match the rung to your goal. And if there's one thing to take away today, it's this. When you pick a pair, don't ask first, how correlated are these two? Correlation is just an observation that they moved together in the past. Ask instead, what is the chain binding these two, and can that chain break? Coke and Pepsi can be 98% correlated and still snap. Two Googles don't even need a correlation check because they're the same company and basically can't. Mechanism, not correlation. That's what separates a beginner from a pro. Let's bring it together. Over 5 parts, we built the tools to trade a pair. Today, we drew the map of what to feed them. A pair isn't any 2 stocks. It's a 4-rung ladder ordered by the strength of the bond. One company's 2 shares, a holding company and its subsidiaries, a stock and its index, and same-sector rivals. And running through all of it, one line. Mechanism, not correlation. With that, the fundamentals are complete. From here on, we go advanced. Exactly how CAPM meets pairs trading, what a market-neutral model is, and the profit profile. A single picture that measures risk against expected return. Time to sharpen the tools. Thanks for being here. And one note, the names mentioned today are examples to explain the ideas, not recommendations. Everything on this channel is educational, and none of it is financial advice. I'll see you in the advanced parts.